I'd like to welcome everybody to the June chapter webinar, the New York City chapter of the American Association of Individual Investors. I'm Hollis Wagenstein-Herturk. I'm the New York City Program Chair and the National Chapter Liaison. And tonight's program features Rob Bernstein. The topic is equity-like returns with a bond-like volatility. Is it still possible? Joining me tonight are my fellow New York City board members, our treasurer, Paula Odellis, our recording secretary, Nona Aguilar, our facilities chair, Shirley Sherrock, our communications chair, Larry Dietrich, and unfortunately not able to join us tonight is our chapter president, Scott Brewster, who is usually my co-pilot for these presentations, but tonight I'm flying solo. Scott is out of town at a conference. We'll miss him, but I'm sure he'll have a chance to catch up with the recording. We ordinarily announce upcoming chapter meetings at this time, but for the moment, the New York City chapter is probably going to take the summer off to strategize and plan ahead for a new environment. We hope to return to live meetings, which will almost certainly be live streamed, meaning that people can attend in person or they can attend online, whichever works for them at the same time. And of course, we'll continue the tradition of recording them. I want to remind everybody here, there's a link at the top of the chat to the New York City community homepage. We've set up the new community portals for every chapter. So that will become the new way we send out meeting announcements, invitations, and we post recordings and other documents, slide presentations, and things that might be of interest to our members. There are no more physical snail mail mailings. And right now, I have to say, community is the new coin of the realm. So if you haven't already signed up for community, please click on the link at the top and make sure you set your profile to receive all the communications that you want to receive. There are just a couple of things I need to let you know to make the most of this presentation. It is being recorded, and for that reason, we're going to be shutting down the chat during the speaker's remarks so that it doesn't distract the people who view it in recorded format. Please hold your questions to the end of Rob's presentation because, number one, he may think of them and answer them in his presentation. So I will save you a little time and trouble, and you can move on to a question that has not yet been addressed. At the conclusion of Rob's remarks, you'll have an opportunity to post your questions in the chat, the Q&A box. You'll see the Q&A icon at the bottom of your screen, a little bit left of center. It looks like two cartoon balloons, one on top of the other, and that's where the questions will go. But we ask that you wait until the conclusion of the formal remarks. I will read the questions for the purpose of the recording so that people who listen to the recorded version know which question Rob is answering. I wish we could have an open mic like we do in live meetings, but unfortunately we can't do that when we're using Zoom. So please forgive us and save your questions to the end. We'll be happy to answer them. That's pretty much all I have to say. So now it is my privilege to introduce our speaker, Rob Bernstein, who will be talking about, that comes a little later. I want to say that you have to go through, when you're introducing a speaker, you have to go through the standard stock bio. Some of those bios bore you to tears, but in this case, it'll make you pick up your ears because Rob is an extreme example of street creds in the area of quantitative finance. He is president of RGB Capital Group, where he manages personal and client accounts. He also offers two newsletters, RGB Perspectives and Market Monitor. I subscribe to both of them and they're both free and they're extremely worthwhile. And I encourage you to subscribe as well. And as soon as Rob starts speaking, I will post a number of useful links to Rob's resources that you can follow up on your own. Uh, Rob holds degrees in quantitative economics and decision sciences, and he has an MBA in finance and accounting. He is also president of AAII San Diego Chapter, which, as many people know, is one of AAI's most elite and productive and successful chapters with fabulous programs. And your AAII membership entitles you to sign up not just for the chapter in your local area, but for any and all chapters where you can receive communications and invitations to their events. So I hope you will also sign up for the San Diego chapter as well as the New York City chapter if you have not already done so. But one other thing about Rob, he also serves on the board of the National Association of Active Investment Managers, which has a lot of prestige and credibility attached to it. And it's more than just his credentials that make him one of our chapter champions. When the pandemic first started and we had to scramble for alternatives to live meetings, and we started doing Zoom presentations, Rob was our first Zoom presenter. He gave a presentation, a webinar in November of 2020, which is one of our best attended programs in decades. And he also, he frequently speaks at other AAI chapters, including a presentation he made to Greensboro just a couple of weeks ago. That was a very popular presentation as well. Without further ado, I would like to turn the platform over to Rob Bernstein for equity-like returns with bond-like risks. Is it really possible? Rob, it's your show.
Thank you, Hollis. Thanks. It's great to be back here again with the New York City chapter. I know we've got a bunch of people from New York City. We've also have people from around the country, including my home chapter here in San Diego. So I welcome everyone to the webinar this evening, and I hope we have a great event and you walk away learning something new today. But before I get into the presentation, I just wanted to thank Hollis for that wonderful introduction. But I also want to take a moment to recognize Hollis's contribution. As she mentioned, she's been part of the New York City chapter for 40 years. She's right now responsible for the programming for the New York City chapter. And she mentioned her role as liaison with the national office. And I just wanted to highlight that role because regardless of the chapter that you're with, whether it be New York, Los Angeles, San Diego, Greensboro, St. Louis, Hollis is playing a role in making sure that your chapter is successful. She's working diligently, rolling out this new community platform, making sure that the events are announced and members get those announcements timely and people are set up and able to log in. So she's doing a tremendous amount of work behind the scenes, helping all of our chapters, all the 30 plus chapters around the country. So thank you, Hollis, for all the hard work. I know I'm personally benefiting, our San Diego chapter is benefiting, and all the other chapters are benefiting across the country. So we appreciate everything you're doing for the chapters and being our advocate for between us and the leadership in Chicago. So much appreciated.
Thank you for that recognition. I appreciate that too. Thanks so much.
You're welcome. It's well deserved. So we've got a lot to cover tonight. So hopefully you're comfortable. I think I saw in the chat, maybe someone's sitting with their gin and tonic. I'm a little jealous, but maybe I'll have one waiting for me when I'm through here tonight. My goal here this evening is to help, my hope is that everyone walks away with something new, something that will change their investment decision-making process so that you're a more successful investor in the future. I don't expect everyone to agree with everything that I have to say this evening, but I hope that it spurs some discussion within your own mind about how you approach investing, how you approach managing risk. And hopefully that has a benefit for you over the coming weeks, months, and years. So with that, this is the agenda for today. What I'd like to start off with is to share a framework that covers the business cycle. The business cycle is simply a a cycle of repeating economic expansion, followed by contraction. How do we know where we are and how do we adjust our portfolios to take advantage of that knowledge? Then I want to jump into an investment approach that uses moving average timing techniques. This may be a review. In fact, Hollis, if you could put up the poll right now. What I'm curious is, I know many of you out there may have seen the November 2020 presentation I did to the New York City chapter. You may have seen it in Greensboro a couple of months ago. You may have been following me for a while. So I'm just kind of curious if you've heard me talk about the moving average timing techniques, particularly around high yield bonds, or if this is a brand new topic to you. That'll help me kind of tailor my message appropriately based on the audience. So if you could just quickly fill out that poll for us, that would be super helpful for me. Regardless of your experience with it, I will make sure that everyone is up at the same level and has the same understanding. And we will move into our third topic, which is how to turbocharge your low volatility portfolio. And this is kind of one of my favorite parts of what I do for my own personal investing, the investing I do for my mom and for my clients. And so I'm excited to share that with you this evening. So it looks like, just looking at the poll responses here, it looks like everyone has responded at this point. About 60%, this is their first time hearing it. About 40% of the folks have heard it before. Not a problem. I will make sure that we get everyone up to speed and everyone's talking from the same song sheet. So let's dive in and get started. As I said, I want to start with a discussion of the business cycle. In the whole concept of cycle and waves, cycles are everywhere, right? They're a natural occurring phenomenon. They can be found when we talk about light, about sound, about energy. And cycles also exist within our social systems, right? Like our economy. So this chart that you're seeing on the screen here is a depiction of the typical business cycle. The typical business cycle is, and this has been demonstrated over hundreds of years of history, that we have expanding economy that's followed by a contracting economy. And this pattern of prosperity and recession repeats itself over and over again. The time frames can be different. The causes for those expansion and contracting periods of time are different over time. But what is consistent is this repeating pattern of expansion and contraction. So the question is, how do we know where we are? And I'd argue that we don't need a PhD in economics anymore to understand generally where we're at. In this information age that we exist in today, there's a lot of this data that is readily available to individual investors. And with that knowledge and with that information, we can have a fairly good idea of where we sit in this repeating pattern of expansion and contraction. We never know for certain where we are, but we can make a pretty good judgment of where we are on this repeating wave, or on this roller coaster, if you will. So let me just bring these up. So let's go through, this is just sort of like a checklist. These are some of the characteristics that are associated with the different phases of a typical business cycle. And being a cycle, we can really start anywhere. In this case, I'm just going to start with the expansion phase of the typical economic cycle. And that's really characterized by increasing and growing gross domestic product, or GDP. We've got high consumer confidence, and high consumer confidence leads to high consumer demand. And with high consumer demand, there's a lot of demand for goods and services that keep the economy going and growing. And as the economy expands, demand for different resources, whether it be capital, labor, raw materials, all start to increase, right? As Businesses need to meet additional demand. They need to increase their capacity. That additional capacity requires capital to build those additional resources that they need. They need additional labor to fulfill the delivery of the goods and services that they're providing to their consumers, and all the raw materials that go into making those goods. As we all know in basic economics, the increase in demand, all else being equal, will drive prices higher. And this results in inflationary pressures in the economy. These inflationary pressures will eventually cause bond yields to rise, as bond investors require higher yields to hold these longer dated bonds, given that inflation pressures in the economy. And as bond yields rise, bond prices fall, right? We all know that yields and bond prices are inversely correlated. Eventually, that expansion grows and comes to a peak. And that peak is typically defined by a Fed that begins to increase short-term rates to attempt to control inflation, right? The Fed is always in a battle with itself. It's either battling inflation or it's battling recession, right? It's trying to keep us out of recession, and it's trying to tame inflation so that inflation doesn't get out of control. But at a peak of an economy, we start to see these inflationary pressures, and the Fed begins to increase short-term rates in order to slowly slow down the economy. As these interest rates start to rise, stocks tend to peak on the anticipation of declining earnings in the future, right? If the cost of capital increases, that's going to have a direct impact on the bottom line of a corporation and impact future earnings. What we typically see during this peak phase of the economic cycle is commodities tend to continue to rise, at least temporarily, but they eventually decline with the rest of the economy. As the economy slows, the business environment sort of adapts to this new environment, right? We start to see layoffs. We start to see a reduction in capital spending. And these things are associated with sort of that peak in the expansion. This leads to a contraction in GDP growth, or it could be a contraction, or it could be a slowdown in the rate of growth. This certainly has an impact on consumer confidence as layoffs start to increase. The amount of consumer spending declines and consumer confidence dips. Eventually, if we get into a full-blown recession or contraction, bond prices will eventually top as the market anticipates that the Fed will begin to lower short-term rates. And with short-term rates, sort of peaking, as they start to go down, bond prices will start to climb. Now, what we've seen historically is that the Fed keeps short-term rates too high for too long. Their goal is always to engineer a soft landing. However, historically, they haven't done a fantastic job of doing that. And as such, they keep rates too high, pushing the economy into a recession. GDP may turn negative, doesn't have to necessarily to indicate a recession, but it certainly may turn negative. Eventually, the cycle will bottom. Bond yields will start to increase as the Fed tries to increase the supply of credit to spur economic growth. Stock prices will bottom eventually in anticipation of higher growth and earnings in the future as the economy gains traction. And again, this is a cycle and it'll all start over again. So where are we today? Well, if I was to use this as a checklist, let's kind of start at the top here. Gross domestic product is increasing, consumer confidence is high. I would say that's a check mark. We've seen that over the last couple of years since the pandemic low. We've certainly seen a huge demand for capital, particularly for labor resources. There's certainly more jobs today than there are people to fill those jobs. We're certainly seeing inflationary pressures in raw materials and commodities. We've seen a rise in bond yields, a peak in bond prices. So bond prices have started to fall about 12 to 18 months ago, as yields start to rise during this inflationary time. So we've definitely hit all these buttons, all these checkpoints in the expansion phase. Are we at a peak? Well, let's see, let's go through our checklist here. The Fed begins to increase short-term rates. Well, we've certainly seen that this year. The Fed has been aggressively trying to slow down the economy through both raising short-term rates and their quantitative tightening processes. We've seen a peak in stock prices, absolutely. Stock prices peaked at the end of last year and have been in the decline for the first 6 months of this year. Commodity prices, they continue to rise. That is certainly the case today. And I think for the time being, there's no indication that has changed, although it could change at any moment if the overall rate of growth in the economy starts to slow. Eventually, the economy slows as the business environment adapts to this new environment. Well, I guess I would say we're starting to see some hints that the economy is slowing. We're starting to get some forward guidance from corporations that are indicating a slowdown in economic growth. Recently, we've seen housing starts, new housing start to dip as interest rates rise and mortgage rates rise. So I'm going to put a question mark there. So I think, we're somewhere, we're close to the peak. We're probably at the far side of the peak. We're certainly not in a recession or contraction phase at this point. So my best guesstimate, and again, as I said before, we never know exactly where we are in the overall typical business cycle. This is where my assessment lies as we speak here this evening. Okay, so what do we do with this? What do we do with this information about the business cycle? Well, certain asset classes, major, broad asset classes, tend to have certain behaviors during different times of the business cycle. And I like to use a framework that was developed by Martin Pring in his book, The All-Season Investor. And that framework really helps us put these different asset categories into context. I'm going to use this chart here to help explain the framework that Martin Pring had put together. I think it's very useful. This top chart here is the economic cycle or the business cycle, as we've just been talking about. This is the contracting phase. This is the trough. We have an expansion phase, a peak, and then it starts to contract again. And this is a cycle, and it starts over again. Now, these bottom three charts depict the behavior of bond prices, stock prices, and commodity prices throughout the business cycle. Now, if we look at the first one, typically bond prices bottom and start to climb higher before the actual economic bottom. If this was the economic bottom, you can see here for this depiction, bond prices typically start to rise in advance of the economy bottoming. That really has to do with interest rates, right? Short-term interest rates starting to come down as bond prices start to rise. After that, and as we get closer to that trough, stock prices bottom. Again, stock prices are a forward-looking discounting machine. So they anticipate better earnings in the future, and stock prices tend to bottom in advance of a bottom in the overall business cycle. Commodity prices tend to lag a little bit. They tend to bottom somewhere during the expansion phase before they start to bounce and recover. So those 3 points are marked by these circles: bottom in bond prices, bottom in stock prices, and bottom in commodity prices. Bond prices then tend to peak in advance of a peak in the economic cycle. Stock prices tend to follow, and commodity prices tend to follow the peak in commodity prices. Now, Martin Pring has defined each of these different points as a different stage in the economic cycle, stages 1 through 6. Stage 1, simply the bottom in bond prices. Stage 2 is characterized by the bottom in stock prices. And stage 3 is characterized by a bottom in commodity prices. And then stage 4, 5, and 6 are defined and characterized by a top in bond prices, top in stock prices, and a top in commodity prices, respectively. The distance in the area here represented by stage 1, 2, 3, 4, 5, and 6 is a rough estimate of how long these phases typically last. Now, each of these phases in any business cycle are going to be different. The timeframes are going to be different. These stages could even happen out of order. This is not a perfect framework to make investment decisions. Certainly, you have to put some independent thought and thinking behind this to make sure it makes sense. But if we have a basic understanding of how these different asset classes behave during different periods of the economic cycle, we can make adjustments to our asset allocations. We can make adjustments to our tactical and investment decision making. If we know if we have a good idea that we're in a peak area and going into a contraction phase, we probably don't want to be heavily invested in bonds. We may reduce our bond exposure. If we knew we were near the trough or the bottom of an economic cycle, this might be a really good time to be overweight in stocks. So looking at each of these stages, we can now tell for stage 1, for example, this is a great time, bullish for bonds, not so great for stocks and commodities. If we think we're in stage 2, this is a great time for bonds and stocks and not such a great time for commodities. Stage 3 is typically a good time to be invested in the market. For aggressive investors, this can be a very profitable time in the market. Stages 5 and 6 tend to be pretty dangerous times in the marketplace. We've got stocks, we got bonds going down, we got stocks going down, and eventually when commodity prices catch up in stage 6, we've got all 3 asset classes declining at the same time. So we can use this knowledge and information to help with our investment decision-making process. Now, as I said before, the business cycle and Martin Pring's framework is not perfect. The average business cycle lasts anywhere from 4 to 5 years, although this can vary considerably. As I said before, stages may not happen in sequence, they may be skipped. And it's really impossible to know with any level of certainty exactly which stage we are in. As I said before, stage 2 is the easiest time to make money. Stage 3 can be a very profitable time. Stages 5 and 6 can be pretty dangerous. And the other thing we need to note is over the last decade or so, the Federal Reserve, as well as other central banks around the world, have had a very heavy hand in influencing the business cycle. And so we need to kind of take that into consideration as well. That certainly can influence the business cycle and possibly skew it from time to time. So where are we today? I like to use a 21-day moving average of these different asset classes to help filter out some of the day-to-day noise. On this chart here, I've plotted in the top panel long-term Treasury bond prices, not yields, but prices. In the second panel, I've put together a depiction of the stock market. This is a equal weight of the S&P 500 large caps, S&P 400 mid caps, S&P 600 small caps, as well as the NASDAQ composite. So this is just an equal weighting of those 4 indices. And then the bottom panel is a broad basket of commodities as represented by the Bloomberg Commodity Index. So this is where I think we are today. If we take a look at the commodity index, it was been in decline. These are 7-year charts, as you can see here up at the top. Commodities have been in decline for quite some time, many, many years. And in 2020, it looks like they put in a bottom or a trough. And they've been in a nice uptrend ever since that period of time. I'm marking that as the beginning of stage 3, right? Bottom in commodity prices. We then, later that same year, had a peak in bond prices. right? That, I believe, is the beginning of stage 4, and bond prices have been declining ever since, as the Fed has steadily been increasing short-term rates to fight off the inflationary pressures that are current in the current economic environment. About a year later, we got a top in stock prices. Our blended stock index here peaked in late 2021. And as most of you know, anyone who's been paying attention to the stock market knows that the market has been in decline for the first 6 months of this year. So my best assessment currently is that we are in stage 5 of the business cycle. As I mentioned before, I personally believe this is a fairly dangerous time for most investors in the stock market. And we can use that knowledge, right? We can use that knowledge to reduce our allocation to equities. We can use that knowledge to reduce our exposure to the bond market and wait for a better time to make some of those tactical decisions. Now, I wouldn't make any specific investment decisions based off of this framework, but you can use it as additional information that you put into your calculations when you are making your investment decisions. So bottom line, stage 5, pretty dangerous time in my opinion, to be invested long in the bond and treasury market. A pretty good time to be in the commodity space. However, that party too shall end. And when it ends usually rather quickly. So what I'd like to do now with kind of that piece behind us, I think that's just a good overall background. Hopefully you find some value in that and have the ability to use that in your investment decision-making process. I'd like now to move into the concepts of a investment approach that I use for myself, my mom, and for my clients that uses moving average timing techniques with low volatility asset classes. Now I'm going to go through a series of slides here that will give you enough information to understand this. If you'd like to review a recent presentation I did to the Greensboro chapter, I believe Hollis has a link to that video recording that she can put into the chat. Feel free at your convenience to take a listen and a look at that webinar. And you can get a little more detail out of that than I'm going to go into this evening. But certainly I will go into this at a level of detail that will be not only great for first timers, but also a great review. And I think this is a perfect time to be reviewing this type of approach. And the reason why is the fact that we're in those later stages of the business cycle. We're in stage 5. This is the stage that creates the opportunities for us to really create additional upside potential in our portfolio. So having a good understanding now, reviewing these techniques at this point will prepare us for the opportunity that ultimately will be created. And I'm going to share a little bit about what that opportunity currently looks like. Okay. So hopefully, Hollis, you're able to put that link to the Greensboro recording up there for those who want to take a look at it.
The link is already recorded in the chat box among all the links are posted there. We'll try to post them again towards the end, but we don't want to get it kind of lost in all the chat. The links are there.
Perfect.
Just check chat.
Thank you so much. So before I get into the actual strategy and the approach, there's 2 slides that I really want to share with you. These are 2 of my favorite slides. These are 2 slides that keep me grounded as I make my investment decisions. The first here is a chart that shows the impact of a portfolio loss and what it takes to recover from that loss. And the way you read this chart is the red area here at the bottom represents the potential loss you could incur in your portfolio, anything from 0% all the way down. In this case, it shows up to 90%. The green shaded area represents the gain required to break even. So a small, relatively small loss of 10% or less requires a relatively small gain to break even. A 10% loss requires an 11% gain to break even. Now, if you experienced a larger loss, say a 50% loss in your portfolio, that would require a 100% gain just to break even. So think about it. If you had a $500,000 portfolio and you lost 50% of it, you would be left with $250,000. You would need 100% of that $250,000. You would need to double that just to get back to break even. And we all know that 100% gains don't come around all that often. If anyone was invested heavily in the NASDAQ back in 2000, they may have experienced a 75% loss. Experiencing that type of loss requires a 300% gain just to get back to break even. So the message that I want you to take away from this slide is that the impact of portfolio losses, the further you go into the hole, the harder it is to recover. If you are able to minimize your losses, and we all experience losses, it's just part of investing. There's no one out there who does not experience a loss. What I believe makes a difference between a good investor and a great investor is someone who can maintain portfolio losses to a minimum. So keep this chart handy. I think it's super valuable. It sort of grounds me as I think about my investment decisions and the risk that I'm going to expose myself, my mom, and my clients to. And try to keep your exposure to the downside fairly limited. I'm going to try to show you how you can do that tonight. My other favorite slide is this scatter chart. It's a risk versus reward chart. On the x-axis here, we have standard deviation, which is a measure of volatility. And volatility certainly implies risk. Lower volatility on the left, higher volatility on the right. And on the y-axis here, we have annualized return, the annualized return of a particular investment. Now, I've plotted a few indices out here. These are equity indices, the New York Stock Exchange, the NASDAQ, the S&P, the Russell 2000. They all have relatively high volatility characteristics when compared to bonds and money market. So this total bond fund from Vanguard and this money market are at the lower end of the scale, where the equity indices are obviously at the higher end of the scale. This solid line here that have been plotted is simply a regression line. And that regression line is nothing more than a line that best fits those 6 data points that you see on the screen. And the reason I've plotted that is that it shows there's a trade-off between risk and return. The more risk you expose yourself to, the higher the return you would expect over time. Now, not every investment is going to fall directly on that line. So I draw these 2 parallel dashed lines, and these 2 parallel lines and the area between those 2 parallel lines represents what I consider the long-term expected return channel, the area where most investments are going to fall. And you can see that if you were to expose yourself to an investment that had volatility characteristics about here around the 6, you would achieve about somewhere between a 3 and a 7% over a long period of time. That's just generally what this chart is telling us. And the data in this chart goes back all the way to the beginning of the century. So we've got about 22 years of data here to back that up. Now, at the other end of the spectrum, if you were to take lower volatility, this Vanguard, like a bond fund, for example, you'd expect somewhere between the 1 and 5% range. Now, what's important here is, as investors, we have all the ability to control how much risk we take, and we have very little control over the annualized return. And what I mean by that is we as investors have the ability to decide what we are going to invest in. We can invest in a money market, which we know will have very little volatility, right? A money market's designed to protect its value of $1, or we can invest in a more volatile equity index, which is going to be very volatile, or we can create a portfolio that lands anywhere in between those two. Now, that is what I mean by we have all the ability to control how much risk we expose ourselves to. We can take very low volatility or no volatility, or expose our portfolio to very high volatility. Now, on the return scale, we really don't have any control over that. I'll use the money market as an example. Money markets, as we all know, over the last decade have paid very little, less than 1%, less than 0.5%. But over this 22-year time period, they've provided returns that are just shy of 2%. That is all dependent on the market and market conditions. In the early 2000s, money markets were paying much higher returns than they are today. Now, all of the investors that I usually speak with, they understand that they have to expose themselves to some risk, and they're willing to take a small step out on this risk scale. And most of them want to try to achieve as much return as they possibly can for that given level of risk. What I try to do, and what I'm going to try to share with you today, is how to achieve what I call better risk-adjusted returns, taking a small step out on the risk scale and trying to reach as high up into this upper left-hand quadrant as I possibly can. Now, make sure you understand this chart. We're going to refer back to it several times throughout the presentation. But this concept of better risk-adjusted returns, the concept of moving into this upper left-hand quadrant, is consistent with most of the investors that I speak with. Now, the approach that I've referred to here, this investment approach or this technique, emphasizes the use of low volatility investments. And most low volatility investments tend to be bond or income related for the most part. And I break those low volatility groups into two categories. One are interest rate sensitive investments, and the other are economically sensitive investments. The interest rate sensitive groups include treasury bonds, corporate bonds, bonds that have are very sensitive to interest rates. As we talked about earlier, as interest rates rise, the prices of those bonds fall. Prices and yields are inversely correlated with each other, and there's that direct relationship. On the other hand, we have other asset classes that obviously are influenced by interest rates as well, but they're also influenced by overall economic conditions. And this evening, I'm going to focus in on the category here of high yield bonds, also known as junk bonds. I'll try to explain why and how these types of bonds are more sensitive to overall economic conditions as well as interest rates. Now, I'm not proposing that anyone go invest in an individual corporate bond or an individual high yield corporate bond or an individual emerging market bond. What we're talking about this evening is investing in mutual funds that track these different groups, that invest in many bonds in that category. And history has shown that these funds take on very low volatility trends. And because of this trend persistence, if you will, because of their persistence to take on a trend and those trends stick for a while, it increases our probability of success at generating better risk-adjusted returns. So let's first dive in. Let's talk about junk bonds or high yield corporate bonds. They're the same thing. And what I'd like to do is give you a sense of how they work. This chart here in green shows the S&P 500, and in red we have what they call the B of A Merrill Lynch U.S. High Yield Master 2 Index, or for short, the Junk Bond Index. This index tracks the U.S. junk bonds and their price movement over time. And one of the things that you will notice here is that junk bonds have generally tended to trend in the same direction as the stock market. You can see here the bottom after the 2000 tech bubble blew up, both junk bonds and equities trended up at the same, basically the same rate. They both peaked at about the same time and started to trend down as we entered the 2008 financial crisis. And then they both bottomed about the same time and started to trend up again. So you can see that junk bonds, high yield corporate bonds, tend to trend in the same general direction as equities. And as we have these smaller declines, like this is the 2015 into 16, there's some concerns about global growth. Stock market started to fall apart and junk bonds started to decline. Same thing here. This was the pandemic related sell-off in March of 2020. The stock market slid very hard, very fast, and so did junk bonds. So you can see there's a relationship between the behavior of equities and junk bonds. So the question is, why is that? Well, let's take a look. This is a chart from 2011. The green line here is the 7 to 10 year Treasury bond ETF. The symbol is IEF in green, and in red, we have the junk bond index. You can see at the first 6 months of the year, first 6 or 7 months of the year, both treasuries and junk bonds were trending up at about the same pace. And then something happened. Something happened in the middle of the year that caused treasury bonds to surge higher and junk bonds to plummet. In this particular case, this was the summer of 2011, and the folks back in Congress were debating whether or not to raise the debt ceiling. I don't know if you guys remember all this time, but there was a time where our elected officials were debating whether or not to raise the debt ceiling. If they didn't, it would create some uncertainty in the market as to whether or not the U.S. would be able to meet all of its financial obligations. This obviously created uncertainty. Investors do not like uncertainty. And so at the time, investors fled to the safety of US treasuries. And at the same time, junk bond investors demanded a higher yield to compensate them for the additional risk that was now in the financial markets. And as we know, as yields rise, bond prices fall. So what happened here is that junk bond investors demanded a higher yield. That higher yield created downward pressure on price, and junk bond prices plummeted. And so that's the difference between a typical interest rate sensitive bond and a economically sensitive bond. And as we all know, equities, when risk rises, stocks tend to move down as well. And so you can see there's a relationship between the way junk bonds behave and the way equities behave over time. And we've seen this pattern happen over and over again. I'll give you one more example here. This is the 1 year period that led up to the pandemic. You can see junk bonds and treasuries were trending up at about the same rate for most of that 1 year time period. And then in the middle of February, treasuries surged higher and junk bonds plummeted. And it has to do with the same thing. Investors fled to the safety of US treasuries. Risk was high, uncertainty was high. We had never seen anything like this before. We've never seen an intentional shutdown of the US economy. This created all sorts of uncertainty in the market. Junk bond investors were demanding much higher yields to compensate them, and that drove junk bond prices down. So hopefully that gives you an idea. Are junk bonds really bonds or are they equities? I would argue they're a little bit of both. And it's those characteristics, those bond and equity-like characteristics, that make them such an attractive investment for investors. And I'll show you why. So this is this chart. This is the same chart we looked at before. Junk bond index in red. The green line is the S&P 500. And you can see over here the annualized returns. The annualized returns were in the 5 to 6% range for both S&P and the Merrill Lynch, relatively close over this 20+ year time period. However, what I think is more important, and you'll hear me say this over and over again tonight, is the volatility. The volatility of the junk bond index is about 1/4 that of the equity index. Yes, the volatility of the junk bond index is 1/4 that of the equity index. So if I was a buy and hold investor, which I'm not, but if I was, I would much prefer to be a buy and hold investor of junk bonds than I would equities. We get, let's say, about the same return, but I'm getting that return on a fraction of the volatility. That is virtually the definition of a better risk-adjusted return that we just talked about. Higher returns on lower volatility. And because of this makes junk bonds a pretty attractive investment for most investors, and especially conservative investors. So if we were to plot just the junk bond index on our risk reward chart, you can see that we're starting to move outside of that long-term expected return channel, right? We're starting to move up and to the left in this scatter chart, which is the definition of better risk-adjusted returns. You can see it provided about equivalent returns to equities, but it did so on a fraction of the volatility. So this is one way that investors can move outside of that long-term expected return channel. Hopefully it allows them to sleep at night a little bit better. They're not exposed to the extreme volatility that we see in the equity markets, but it provides very similar returns. But we can do better. And that's where this moving average timing technique comes in. Moving average timing is a very simple process. The process is very basic. You own junk bonds when they're moving up above their moving average, and you move to cash or a money market when they're trending down below their moving average. So on this chart, I have the junk bond index in red, and I have a 50-day moving average in purple. I've labeled a couple of points here. Point A is the peak in the index for this time period. Point B is the point at which the index crosses below its 50-day moving average. Point C is the bottom or the trough in this particular decline. And point D is where it moves back above its moving average. Now, the distance between point A and point B is what I call a timed drawdown. This is the decline between the peak and the time it crosses its 50-day moving average. And this is a very predictable value. Over the history of the database, most declines are within the 1% to 3% range. And that's very predictable. Total drawdown, which is defined as the area from point A to point C, is not predictable. We don't know how long a decline is going to last. It could come down here and shoot right back up again, or it can continue to travel down for much longer. We just don't have any control of what the future holds. And it's this predictability of the time drawdown which makes this time strategy so valuable to us as investors. So the concept would basically be own junk bonds when they're trending above their moving average, move to cash, and then jump back in once they bottom and rise above their 50-day moving average again. So on this slide, I have the same chart that we looked at in the last slide up in the upper panel, simply the index and its moving average. On the bottom panel, I have two lines. The red line is simply a repeat of the index itself. And there's a composite line, a red and green line that depicts the results of making those two trades, the trade at point B and the trade at point D. Now, if we were to have made those two trades during this time period, our returns would have moved from about 3% to about 9%. Now that's pretty good. Most investors would have found that as a desirable outcome. But again, I'm going to focus your attention on the volatility side because we really have no control over the returns. We don't know in advance what those returns are going to be. But we have a pretty good idea of what the volatility will be. Now, the volatility of the index itself, including this big drawdown, was 1%. And the volatility of this composite line, the red and green line, was about 1/2 of 1%. So again, you can see just in this short time period, we moved from a lower return to a higher return, and we've reduced volatility. Once again, that's the definition of a better risk-adjusted return. Now, if we were to look at the results of moving into and out of the index based on the 50-day moving average all the way back to the beginning of this century, you could see that the returns have moved from 6.6% up to 10.24%. The 6.6% simply the returns of the junk bond index itself in the top panel, and the 10.24% are the returns of this composite line, this red and green line on the bottom panel. Again, the red areas just represent when we were invested in the junk bond index, and the green areas represent the periods of time when we've moved to cash, or in this case, money market. Again, we've got higher returns, but what's more important, again, is that we've reduced volatility. Volatility went from about 1.5 down to about 0.8, almost half the volatility for an increase in returns. Now, the maximum drawdown, the maximum decline in this composite index, in this composite line here, is less than 6%. So a relatively low decline, a relatively reasonable annualized return, and a great reduction in overall volatility. So what does that look like on our risk reward chart? As you recall, we plotted the Master 2 index here with this red diamond shape. And if we were to plot the, if we were to plot the results of that time strategy, timing the Merrill Lynch High Yield Master 2 index with its 50-day moving average, you can see we start to move further up and further to the left, which is consistent with most investors' desire for lower risk, higher returns, and possibly a better night's sleep. This allows investors to, really focus on the things that they do, whether they're retired, playing golf, spending time with their grandchildren, because they're just not subject to the same type of volatility that the overall equity markets are exposed to. Now, I'd like to look at this in a different format. This is a chart format. It's the same data. In the chart, in the red line, we have the S&P. The green line is the Merrill Lynch High Yield Index, and the yellow line is the results of trading in and out of the index based on its 50-day moving average. So we understand how we can go from the S&P to the Merrill Lynch High Yield Index, right? That's simply, this represents a buy and hold of the equity index. The green line simply represents a buy and hold of the junk bond index. And then we just talked about how we go from this green line to this yellow line. And you can see, you can visually see the reduction in volatility, right? You can see that these big up and down movements, the consistent up and down movements in the equity indices just aren't present in this yellow line. You can also see that during times of extreme market stress, that the yellow line goes flat. Like here in the 2008 financial crisis, it went flat. During the 2015-16, what I call stealth bear market, the results of that time strategy went flat. During the pandemic, there was a small decline here. I believe this was probably in the 3 to 4% range, if I remember correctly. But it certainly did not participate in the type of strong declines that were persistent in early 2020. And now you can see that this chart goes through March of this year. You can see that the junk bond index has started to decline, and the results of this time strategy were basically flat. In the bottom section of this chart, I've provided some of the quantitative measurements associated with each of those three lines. We have annualized return. We have these next two are Ulcer Index, which is a measure of downside volatility. Somewhat similar standard deviation, but it's simply measuring downside volatility as opposed to upside and downside volatility. The lower the number, the less volatile that particular investment is. UPI stands for the Ulcer Performance Index. This is a measure of risk-adjusted return. The higher the value reflects a better risk-adjusted return. Max drawdown and standard deviation. Max drawdown is just the largest decline during this window of time, during this 20+ year window of time. I've highlighted in red those values that are least desirable, and I've highlighted in green those values that are most desirable. And you can see that the junk bond index timed with its 50-day moving average produced the most desirable outcomes when compared to the other two. 10% annualized return, less than 6% drawdown, and a standard deviation of 0.8, significantly less than that of the S&P. Now I want you to focus on this drawdown number for a second, because we're going to refer back to this later on this evening. You may even want to write it down mentally, write it down on a piece of paper. But the time strategy had a drawdown of less than 6%. And this is going to be very important to us as we continue to talk about how we turbocharge this low volatility line. Now, I'm going to try to avoid or stave off a question. I always get a question about, can we use ETFs instead of mutual funds? Now, I've been talking about an index, the BAML High Yield Master 2 Index, the junk bond index. And as investors know, we can't invest in an index itself. This green line represents the average of a group of very large junk bond mutual funds. Now that's something that we can invest in, right? It's a representation of the mutual funds themselves. You can see over time that they have followed the same general pattern, the same general trend, but over time, the junk bonds have sort of fallen off in terms of return. And that's because the index does not incorporate any fund expenses. And so this sort of trailing off of returns is to be expected. The yellow line represents an ETF. It's the HYG junk bond ETF. I chose that one because it has the longest history that's available to myself. And you can see it also follows the same general direction as both the index and the mutual funds. But the returns are slightly less than the other two. But what's more important is taking a look at the volatility. The volatility of the mutual funds is very similar to that of the index itself, 1.6 versus 1.5. However, the volatility of the ETF is over 2 times as volatile as their mutual fund counterparts. And the effectiveness of using moving average timing is directly dependent on the volatility of the instrument that you are timing. So if you had 2 choices, say a mutual fund and an ETF, and the ETF was twice as volatile, you are most likely going to get much better results, better risk-adjusted returns as a direct result of the reduction in volatility in the mutual fund. So the question is, can I use ETFs? Well, the answer is certainly you could use ETFs. you just may not get the results that you're expecting. Now on this slide, what I've plotted here is the results of timing the index in red, the results of timing the junk bonds in green, and timing the ETF in yellow. You can see the index and the mutual funds had a very similar chart pattern. The returns are about the same, 10.2 versus 9.9, pretty close. And the volatility of those two are very similar, 0.88 versus 0.81. However, when we applied the timing strategies to the ETF, we had a significant reduction in return and a significant increase in volatility, over 2 times as volatile. So the whole concept and the idea behind this moving average timing technique is to reduce volatility. It will make the results more effective, the less volatility that you introduce into the equation. So I highly recommend we use mutual funds. You certainly can use ETFs. I just don't think you're going to get the results that you would like to see. Now, I mentioned before that this is a great time to review this strategy. And the reason why it's a great time to review the strategy is that we're in the middle of a fairly significant decline. The current drawdown, this chart goes through yesterday. I just updated this for us today. This chart shows that the maximum decline so far in the junk bond index is 11%. That represents the 5th largest decline in the last 22 plus years. And every decline over 10% historically has resulted in a great buying opportunity. So if we look at the .com area, this was a 14% decline. And you can see between this bottom and this trail off here was about an 88.6% return. The next significant decline was during the financial crisis. This was a 35% decline in the junk bond index that resulted in a 100+% gain from that bottom until we entered this period of volatility. The next significant decline was the 2015-16 period where there was concern about global growth. This was a decline of 13% that resulted in a 36% increase that followed that. And then, as we probably all remember more recently, the pandemic, this was a 21% decline in the junk bond index that resulted in a 40% rise in prices before we entered the current peak. So what I'm saying is, and what I'm seeing is, this is a great opportunity in the making. The 11% decline, that may be it. It may go further. We just don't know. The junk bond index, you can't really see it on this chart because it's too big of a time frame, but it did bounce towards the end of May. It bounced right back to its 50-day moving average, and it's now been declining over the last 3 or 4 trading days. So I'm not convinced we've seen a bottom yet, given where we are in the business cycle that we talked about earlier. That gives me some more conviction about that assessment that we may still see further declines in the equity markets as well as junk bonds. And to me personally, that's okay. If we're currently in cash, we're sitting on the sidelines, and the further the junk bonds decline, the better the opportunity that will be created at some point in the future. So that is why this is such a great time to be reviewing the strategy. We can now sit back, we can prepare for and wait for and watch and monitor when that junk bond index does put in a solid bottom, when it does bounce and come back above its 50-day moving average. That'll be a pretty good indication that that all is clear. I just don't think we're quite there yet. But if we can study this and I can share this information with you, you can be better prepared for that opportunity when it does present itself at some point down the road. So hopefully all that makes sense. what I'm going to do is use this last piece, next 20-25 minutes, to talk about how to turbocharge your low volatility portfolio. And what I mean by that is, how do we create additional alpha? You know, we've created this low volatility portfolio, right? We've figured a way to get into that upper left-hand quadrant of that risk return chart. Is there a way that we can possibly juice that a little bit more so we can create a little additional alpha when it's appropriate? So this chart should look pretty familiar to you. We just looked at it. This has the red line, the S&P, the green junk bond index, and the yellow high yield index timed with its 50-day moving average. And now I'm introducing a new line, this blue line. What if we could move from the yellow line to the blue line? Would that be of interest to you? Certainly interesting to me. It is slightly more volatile. You can visually see the increase in volatility compared to the yellow line. It's not all that obvious, but you can pick up that there's just a little more ups and downs in that blue line than the yellow line, but it does provide higher returns. So is that additional volatility, which really isn't that much incremental volatility, worth that additional return? Well, that's up to you as an investor. This may be very appropriate for some investors, and other investors may say, no, you know, the great risk adjusted returns of this time strategy is just perfect for me. Regardless of where you stand on that, and I'll explain how we get there, but regardless of your opinion on whether that's worth it or not, having an understanding of how we went from the red line to the green line, and then the green line to the yellow line, and then the yellow line to the blue line. Even if you walk away today with just that basic understanding, with no intention of ever implementing it, I think you will be better off as an investor, because if you can explain to me how we went from red to green, green to yellow, yellow to blue, that to me tells me that you have a very solid understanding of how to manage risk and return. So let's dig in. So the way we get from the yellow to the blue is through an additional tool, and that tool is called margin. Margin is simply a type of leverage. It's basically borrowing funds from our broker-dealer, from our broker, whether you're trading through TD Ameritrade or Schwab or whoever, and using those funds to purchase additional securities in your portfolio. And the collateral that is used when you borrow those funds are the securities in your portfolio. It's not much different than borrowing and borrowing to purchase a home, right? There's a mortgage process. The big difference is that getting access to margin is a lot easier than getting access to a mortgage. Anyone who's bought or refinanced a house lately will know there's just hundreds of documents you got to go through. You've got to sign, you've got to prove your income, your net worth, your assets. Typically, getting access to margin is pretty simple. You sign a form and away you go. It works very similar to the way a mortgage does. When you sell your investments, when those investments are liquidated, the investor will pay back the amount it borrowed and keep any additional gains or absorb any losses in your account. So you pay interest on the funds borrowed. You pay back the balance that is owed, that you borrowed at the end of the transaction, just like you would your mortgage. If your house appreciated in value at the time you sold the house, you pay back the loan amount and you keep the additional gains. Now, one concept that is very important to understand is that the use of margin will always increase volatility. I repeat, the use of margin will always increase volatility. So that's very important to understand. Now, the increase in volatility will be dependent on the volatility of the portfolio that you are margining. With everything else being equal, the higher the volatility of the portfolio, the higher the incremental level of risk will be for a given level of margin. Now, margin can be a very powerful tool if it's used correctly. However, it may not be appropriate for all investors, and that's okay. Again, I think just having a basic understanding of these risk and return concepts, whether you use them or not, will make, if you have a basic understanding, will certainly make you a better investor overall. So let's go through an example. Let's assume that an investor has a $100,000 portfolio. She borrows $50,000 at 6%, and she invests that $50,000 into the stock market. She has her equity, that's this blue shaded box of 100,000. She borrowed 50,000. That's a total of 150,000. The first 100% is her equity. The second 50% is borrowed money on margin. And she is what I call invested 150%. Now, of course, we owe interest on those borrowed funds. In this example, we're going to use 6%. 6% of 50,000 is equivalent to a $3,000 interest cost per year. Now, it's important to understand the impact of using margin on both risk and return. All, the same concepts we've been talking about, risk and return all evening here. So we want to understand that if we do use margin, what is the impact going to be to the overall volatility of my portfolio? What is going to be the impact to my returns if I use margin? And the calculations are fairly straightforward. If you were to margin a portfolio, you would simply take the standard deviation of that unmargined portfolio and multiply it 1 times 1 plus the margin percentage. And that would give you an estimate of the volatility of your margin portfolio. Estimating annualized return on that margin positions is fairly simple, or very similar, I should say. It's taking the annualized return of the unmargined portfolio and multiplying that by 1 plus the margin percentage. However, we also have to take into account the cost of margin. So we have to subtract off that cost of margin, which is simply the margin percentage times the cost of margin. Now, there's a lot of formulas here, and I know not all of us like to get into formulas. So what I've done here is provided some calculations to give you an idea of what that impact might look like. This chart on the left side is a chart that focuses on the risk side of the equation. The chart on the right here focuses on the return side of the equation. So let's take a simple example. Let's use a unmargined portfolio that has a standard deviation of 1%. If we were to leverage that portfolio up to 150%, right, 100% of our equity and 50% of borrowed funds, we can simply put those two values into our formula, which I've put down here for you. The standard deviation of the unmargined portfolio, 1%, times 1 plus the margin percentage, which is 50%, would increase our volatility of our margin portfolio to 1.5, right? So we have an incremental increase in volatility of 1/2 of 1%, went from 1% to 1.5%. Now, if we were to margin, say, a 5%, a portfolio that had a standard deviation of 5%, putting those numbers, the 5% and 50% into our equation, results in a margin portfolio that has a standard deviation of 7.5%, right? 5 times 1.5 is 7.5, right? 1/2 of 5 is 2.5. We add that to the original 5%, we get 7.5%. So the incremental increase in volatility of a more volatile portfolio is certainly higher than one that has lower volatility. In this case, we had an increase of 1/2 of 1%. And in this case, we had an increase in volatility of 2.5%. So you can see there's a direct correlation between the standard deviation of the unmargined portfolio compared to the standard deviation of the margin portfolio. The higher the volatility of the unmargined portfolio, the higher the incremental level of volatility in the margin portfolio. On the return side, very similar. So I've listed down here the expected returns, or what we might expect our returns to be out of any given portfolio. We have our margin percentage, the same 50%, and our cost of margin. Let's start off with a fairly simple example, a portfolio that provides a 0% return. If we were to margin that portfolio, the return would be 0 times 1.5, which is still 0. But we have to now take into account the cost of margin, which is 6% times 50%, or 3%. So our expected return out of a 0% portfolio margined with a cost of margin of 6% would be minus 3%. Now, if our portfolio had a higher return, let's say 10%, our resulting expected return of that margin portfolio would be 12%, right? We'd have 10% times 1.5, which is 15. The expected return of the portfolio would be 15. Then we need to take into account the cost of margin. We'd have to subtract off that 3%, and we're left with 12%. So you can see margin is most effective when the expected return exceeds the cost of margin. Now, where you get into trouble is if you have a portfolio that produces negative returns. Let's say we went down to a negative 10%, times 1.5 would be negative 15%. But then we also have to subtract off the cost of margin. That would be another drag on the portfolio and would result in another 3% decline. So if we were to margin a portfolio that was trending down at 10%, that would certainly not be a desirable situation. So we certainly want to focus our use of margin on portfolios that are trending up, on low volatility, and that tends to give us better risk-adjusted returns. So let me show you a few examples more graphically. I know there's a lot of numbers here and not all of us appreciate all these numbers. So let me show this to you graphically. So this is the same risk reward chart that we've been looking at. What if we margined the S&P 500 over this whole time period from beginning of 2000 to the end of the first quarter of this year? If we were to margin that portfolio to 150%, we would get a significant increase in volatility, as would be expected. And we would also have a reduction in overall return. You can see that we have higher volatility and lower returns. This is certainly not a desirable outcome. And the reason the returns tend to fall is because on average, the return of the S&P 500 was certainly less than our cost of margin. If we did the same thing with the NASDAQ, you can see that the NASDAQ produced higher volatility and lower returns. This is going the opposite direction of where we want to go. We want to go up into this upper left-hand quadrant. The message here is understand your portfolio and understand the volatility inherent in your portfolio before you use margin. I am not proposing that anybody use margin on a high volatile portfolio. The results will be disastrous. Okay, so let's look at the impact of using margin on low volatility investments like the money market and the Vanguard Total Bond Fund. Well, the money market doesn't have very high returns. So the cost of margin is going to be a drag on those returns. So as you can see here, there wasn't a really big increase in volatility because there's really not a significant amount of volatility in a money market. It's almost zero. So the volatility certainly didn't increase, but the returns certainly declined. And that's a direct effect of having the cost of margin in excess of the overall return during this time period. Well, what if we margin the Vanguard Total Bond Fund? Well, as we would expect, we would have a slight increase in volatility. But again, the returns would be reduced because the average return of the Vanguard Total Bond Fund is less than our cost of margin. So you're asking, well, why are we talking about this? Well, there's a sweet spot. There's a sweet spot up in this upper left-hand quadrant where using margin makes a lot of sense. This is the chart that we looked at before. We have our buy and hold of the junk bond index. We have our 50-day moving average, the results of the timed strategy with the 50-day moving average. If we were to leverage this investment, this timed strategy, where do you think it's going to go? Well, one, we know that volatility is going to increase. So we know volatility is going to go, it's going to go somewhere this way. Now the question is it going to produce higher or lower returns? Well, if we were to leverage that time strategy, so this is the time strategy, timed with a 50-day moving average, using leverage up to 150% at a cost of margin of 6%. You can see that it did increase volatility, which we would expect, but it also increased return. In addition, because the volatility of the original portfolio that we're margining was relatively low, the incremental increase in overall volatility was not that significant. In fact, the volatility of that margin portfolio is pretty similar to the volatility of a bond fund itself. And you can see here that we're moving higher and higher up into this upper left-hand quadrant of this chart. So it's very important to understand the volatility characteristics of your portfolio prior to you using margin. There's this sweet spot, and you want to make sure that your portfolio is in that sweet spot to take advantage of this type of tool. And because it's up in this upper left-hand quadrant, this is very consistent with most investors' desires, particularly conservative investors, to be able to take advantage of additional alpha that is available to us. I use this margin strategy in my work that I do for myself. My mom's accounts are margined when it's appropriate. And that's because it just doesn't have a significant amount of volatility. In fact, it has less volatility than a 100% portfolio invested 100% into any of these equity indices. It's got higher returns and lower volatility. In fact, it's got less volatility than sort of a standard 60-40 portfolio, which, a 60-40 portfolio is probably going to be somewhere in this range right here. A margin portfolio of this time strategy has significantly less volatility than that balanced 60-40, 70-30, whatever it might be type of portfolio. So the results of this use of margin is very consistent with many investors' desire to move up and achieve these better risk-adjusted returns. Now, there's a couple things you probably need to understand when using margin. Again, I suggest that we use mutual funds and not ETFs. Now, mutual funds are not immediately marginable. They must be held in our accounts for 30 days before investors can use them as collateral to borrow against them. ETFs are immediately marginable in most instances. But I find that this weight, because of the reduction in volatility, is well worth it. For those of you who are familiar with margin, certainly margin calls are possible, but they're only possible if the equity percentage in your account falls below your broker's requirements. Now, most brokers require a 30% equity percentage, or what they call a margin maintenance value. And the way you calculate that equity percentage is fairly simple. You take the value of all the securities in the portfolio, you subtract the margin balance, and then you divide it by the market value of all the securities. In our example here, where we had $100,000 of equity, $50,000 of margin, we're 150% invested. It's $150,000, right? That's the total investment of all our equity and margin exposure. We subtract off the margin balance and divide by the total market securities, and it gets to be 66%. Generally, small declines like we experience in the time junk bond strategy, 5, 3, 4, 5, 6%, are not going to cause a margin call. It's just not going to happen. We're going to be out of the market far in advance of the portfolio declining. It typically takes a decline that exceeds 25 or 30% of the portfolio to generate a margin call, to create a situation where the equity percentage in the account would drop below that broker's margin maintenance value or equity percentage. So think about it. How do you think a disciplined investment approach that involves the timing of junk bonds or other low volatility mutual funds would perform in a margin portfolio? Right? So remember that 5.94% maximum drawdown that we emphasized a little while back? We are going to be out of the market using this time strategy. If you were a disciplined investor and you were using this strategy, we're going to be out of the market far in advance of any margin call. So I think the risk of margin calls is extremely low, and that the portfolio will provide those risk-adjusted returns, move to cash far in advance of any account ever coming close to a margin call. So just to kind of wrap up the concepts here, you now know how to get from the red line to the green line, and using a timed moving average timing, you can get from the green line to the yellow line. And with the use of margin, you can get from the yellow line to the blue line. The blue line is simply margined at 150% with a 6% cost of margin. So whether you are comfortable using margin or not, having an understanding of how you move from the red to the green to the yellow to the blue, if you walk away with that this evening and understand that the increase in returns and the reduction in volatility and how all that works, I think you are going to be better prepared for your investment decision making in the future. Because I think these concepts, whether you're investing in junk bonds or stocks or interest rate sensitive bonds, those concepts transcend the asset class. At the bottom here is a similar chart with the quantitative metrics that we looked at earlier. Annualized return, standard deviation, the Ulster index, which was again a measure of downside volatility, the Ulster performance index, which is a measure of risk-adjusted return, and maximum drawdown. Now I've highlighted in green those results that are most desirable. And you can see that from a risk standpoint, standard deviation and Ulster index, the time strategy actually from a quantitative standpoint is superior. The risk-adjusted returns based on this UPI calculation are superior than the timed and margin strategy. However, the return here for the timed and margin strategy certainly exceeds that of the timed strategy itself. To get another 1 or 2% every year compounded annually, that can be quite valuable. I don't know if you guys have heard Paul Merriman's talk about an extra 1 or 2% per year, what that means to your portfolio, that can be very powerful. So with that, let me just kind of wrap this up here. Margin, as I said, may not be appropriate for all investors. If you do start to use it and don't have much experience with margin, certainly use it gradually. But most importantly, use margin with low volatility portfolios, very key. Margining a low volatility portfolio certainly can be less volatile than a non-margin portfolio of equity investments, as I showed you before, and certainly can be much less volatile than a balanced bond equity, 60-40, 70-30 type portfolio. When I use margin to make investments in our client portfolios and my own portfolio, I generally like to find opportunities that have an expected return rate that is about at least twice the cost of margin, right? So if the cost of margin is, say, 3%, I want to make sure that the expected return is in excess of 6. Margins available to us in our non-qualified accounts only. Those are our taxable accounts. Unfortunately, we don't have access to margin in our qualified accounts, which are our IRAs and our Roth IRAs, because the IRS has a concept called unrelated business taxable income. And if you use margin, you may generate this unrelated business taxable income, or UBTI. And so most brokers won't allow you to even get a margin account, so it's not even really a question, but that is the reason why. So this is a tool that we can use on our taxable accounts. Just to wrap up here, we can use these moving average timing concepts and these concepts of using margin on all the low volatility asset classes that I talked about. I think they work particularly well with the economically sensitive groups that I referred to on the slide earlier. If you like to keep track of these groups, I do publish a monthly newsletter, as Hollis mentioned, and I publish charts of these 10 groups in that newsletter. It's a complimentary newsletter if you think you might get some value out of receiving it. On the survey that's going to be available to you, please check the box that says you want to receive it. I'm happy to share it with you. The survey should be available when you leave the webinar this evening. And I think Hollis was going to try to put a link to the survey in the chat as well. You can click on that directly. That might avoid some confusion. Sometimes that link doesn't always pop up for everyone when they leave the webinar. So certainly subscribe to that. I talk about all these bond and income groups and share my thoughts about what's happening in the market. In my hopes to help you be more successful. In addition, I wanted to let you know about a meeting that we're holding through the AAII San Diego Chapter. I run a special interest group through the chapter. It's called our Risk Management SIG Group, or Special Interest Group for short. Our next meeting happens to be 2 weeks from today. It will be a Zoom meeting. Registration is required. I think we have a registration link that I sent to Hollis. If I did, Hollis will put that into the chat box as well. You can also, in the survey, indicate that you'd like to receive a link. Excuse me, sorry about that. During this session, we are going to talk about how to leverage Fast Track, which is the tool that I use on a daily basis. Excuse me, I'm losing my voice here. Fast Track is a tool that I use on a daily basis to help manage this type of strategy. So I will share with you how you can leverage Fast Track to create these low volatility portfolios, how you can backtest these strategies, how you can backtest the use of margin. So if you're interested in joining us, please register. Well, everybody's welcome. There's no cost to attend these meetings. Although we do accept contributions to help support our chapter if you feel you're able to do so, but certainly not required. In addition, for those attending, if you are not a current Fast Track subscriber, we will have a a coupon code for you to get, I think it's a 50% discount on a 6-month subscription to Fast Track. I don't have any relationship to Fast Track, so I don't get any value or benefit from that. I'm sharing that with you as that's the tool that I use. As Hollis said, I also produce a weekly newsletter. This is a 1-page quick kind of summary of what I see happening in the market, what we're doing in our client portfolios to adjust to those changes in the market. Again, happy to share that with you. If you would like to receive that, simply indicate that on the survey form and we'll add you to the distribution list. If all else fails, you're unable to get to the survey, feel free to send me a email. I'd be happy to be a resource for you as you kind of explore these concepts and ideas. Feel free to reach out via email and I will respond to you just as quickly as I can. If you're looking for the survey when you leave, it should pop up. It should ask you to continue, that it's taking you to an external website. Just hit continue and it should take you there. So I appreciate the time this evening. I hope that was valuable to everybody. I went a little longer than I expected, but I think we still have some time for a few questions, Hollis, if there's any questions out there.
Rob, first of all, thank you for a transformational presentation. I think everybody will agree with me. It was time very well spent. I will make one comment about the evaluation form that you mentioned. It will pop up as you leave. It's been coded into Zoom. So when you leave Zoom, you should automatically be invited to fill out the evaluation form and request the subscription that Rob mentioned. We will also post, we'll give you a second chance, we'll post the link to the evaluation form when we send out the recording, which will go out to everybody in community who belongs to the New York community page. And those who have either heard the recording or have listened to the live presentation will have a chance to evaluate. And the link is already in chat. I'm not going to repost it. It's there. You'll have to do just a tiny bit of scrolling, click on those links and activate them, because this is the moment when I have to turn my attention to the Q&A. Now, Rob, I'd like to ask you something, because you have been so generous with your time, your information, your insights and acumen. And I noticed that you're struggling just a little bit to keep on talking. Would you like to handle the questions live right now? Or would you like to receive the questions after the fact and be able to write a synopsis of your answers that we can append to the recording when we send it out? What's your choice?
Let's take a few questions now. I know we've been going for about an hour and 45. I think we got a little time for a few questions. If we don't get to them all, I'm happy to respond to them in writing. And certainly if you have the ability to attach those to the presentation, then that would be fantastic. Then we can address.
We'll get started now. And I would like to start with one quick question. You said to pick leveraged investments on margin that have an expected return of at least twice the rate of margin. And you used 3% as an example. But in all the brokerage accounts that I have, my margin rate, my preferential margin rate as a good customer, range from 7 to almost 9%, which would require me to find an investment with an expected return of 16 to 18%, which may be a little bit aspirational. So in the real world of higher margin rates, how do you address that, or how do you cope with that?
Yeah, that's a great question, Hollis. The typical brokerage accounts, and I'm not familiar with all their margin rates currently. I do know, for example, TD Ameritrade had fairly high margin rates. There are opportunities out there to find lower margin rates. I know Interactive Brokers has some of the best margin rates in the industry. They're very, very good. I also provide clients, what I call our tier 2 clients, the opportunity to access my professional trading platform. They still manage their money, they still make the investment decisions, but then they get access to my margin rates, which are much more reasonable than the typical Schwab and TD Ameritrade. if anyone's interested in exploring that further, certainly send me an email. Happy to share that with you. The cost of that service is pretty small. It's 0.1% per year, so very limited on the expense side for my services to open that up to you. But it's a way to access margin at a much more reasonable cost than some of the traditional brokerage firms.
Okay, one of our listeners, Satish, forgive me if I mispronounced your name, Satish. What about the tax consequences of this 50-day moving average strategy?
Like anything in when it comes to finances, taxes are a reality. Whether you sell a house or a security, you will owe taxes on it. My goal is to protect capital and not minimize taxes. I find it much more important to protect capital, particularly for investors that place a high priority on capital preservation. So unfortunately, taxes are just a thing that we need to deal with, and certainly when you sell and buy, you will be subject to taxes.
Thank you. Ming Ko asks, which mutual funds or actively managed ETFs use a similar system to the one you described?
Good question. So I think the question here is, is there a mutual fund or ETF that deploys this type of strategy? I don't know of any directly that deploy this specific strategy. So I don't think I have an answer for you. I certainly haven't found them, and that's why I provide these types of services for my clients. But certainly you can do it yourself if you have the time, knowledge, and desire to do so. If not, certainly find someone you trust who can help you out.
Thank you. We have a question from Conrad Franz. He asks, can you explain why the mutual fund produces a better return than the ETFs, since ETFs are typically at lower cost?
Certainly. So the ETFs, for a couple of reasons, I think they have higher volatility and lower returns for a couple of reasons. One is, the ETFs can be traded much more frequently. Many of the mutual funds may have some limitations on the frequency you can trade. I find all those limitations very manageable. ETFs you can sell at any point during the day. Mutual funds you can only sell at the end of the day. That increase in trading will certainly have an impact on overall volatility and returns. In addition to that, because of that liquidity requirement the ETFs have, they may use more derivative type products, which may be more volatile, or they may have more money sitting around in cash, depending on what those needs are. In addition, ETFs typically follow an index, whereas a mutual fund, typically in the case of these junk bond mutual funds, have a manager who is actively managing the portfolio. And so the difference is also the ability of the portfolio manager is reflected in the results of that mutual fund. And so those fund managers that are doing a good job, an excellent job of managing those portfolios, they don't have to invest in everything that's in the index, but they can pick and choose. They can pick and choose where they see the opportunities. And so you might also be seeing the results of fund manager performance.
Thank you, Rob. A question from Ravi Vidula. I'll read it verbatim because it's a little bit complex. What is the rationale behind the 50-day moving average versus using a longer 200-day or shorter moving average, like a 10-day? And with respect to momentum trading strategies, do you ever consider shorting the HYG ETF at the turning point in terms of return or standard deviation?
Okay, so let me start with the first piece there. Why do we use a 50-day moving average versus any other moving average? It has to do with a couple of things. It has to do with the resulting volatility that's generated out of that portfolio. It has to do with the returns that are obtained using different moving averages. And it also has to do with the number of trades per year. If we could trade an unlimited number of times, obviously a shorting moving average may provide better results. It may provide higher returns, may provide lower volatility and lower drawdown. However, with mutual funds don't like you trading in and out on a daily basis. And so the 50-day moving average is sort of a sweet spot that provides a reasonable return, reasonable expected drawdowns, and over the last 20 so years has had about, I believe, two and a half trades per year on average. And so it's that balance between risk, return, and number of trades. Now, if you take a look at the presentation I did to the Greensboro chapter, I have a whole slide on the results of different moving averages anywhere from, I think, 10 to 90 days, if I remember correctly. So take a look at that presentation and you can see the results of those different moving averages. With respect to going short, HYG, again, HYG is pretty volatile, at least relative to the mutual fund counterparts. And as I said, the effectiveness of moving average timing is dependent on the volatility of the instrument that you are timing. The higher the volatility, the less effective that result. I think moving in and out, shorting and then going long, shorting, going long, you're going to get whipsawed during certain periods that it's going to be less effective. The actual results may show lower returns and higher volatility is what I would expect, but I'd have to back test that.
Thank you. A question from Ray Jordan. Would it be sensible to use the MLHY index to generate signals that are then used to trade with ETFs, on the premise that that would reduce the volatility of the ETF signals?
Yeah, Ray, it's a great idea. I've tested that. Unfortunately, I just haven't found that the results are any better than simply using the mutual funds themselves. And the reason why is if we're getting into a downtrending market, the trigger in the mutual fund may come at a point that is late with respect to the performance of the ETF. The ETF may be significantly down well in advance of a decline in the mutual fund, and it has to do with that lower volatility of the mutual fund itself. So in a downtrending market, I think you're going to experience significantly higher declines. I'm not saying you can't do it. Those drawdowns, those bigger drawdowns, relatively speaking, may be acceptable to you as an investor, but you have to ask yourself and be comfortable with those types of drawdowns. For me, using the moving average on the mutual funds themselves, because of that lower volatility nature of those mutual funds, certainly produces the best risk-adjusted returns that I can find.
Thank you. We have a question from Dan Chambers. He'd like you to provide some good junk mutual fund recommendations.
Certainly, I don't have any off the top of my head that I can share with you. And the reason is junk bond mutual funds, they change over time. Most of the big fund companies, whether it be PIMCO, Vanguard, Fidelity, BlackRock, they all have their own version of a junk bond mutual fund. You can look them up. Most of them are fairly large mutual funds, so they're relatively easy to get into and out of without making a a big impact on the fund itself. But the reason why I don't provide individual recommendations is that things change. Let me give you an example. There was a mutual fund. It was called Northeast Investors Trust. It was one of the best junk bond mutual funds available back in the 2000s. And something changed. I don't know if it was the portfolio manager changed, their approach changed, but that went from being one of the best junk bond mutual funds to a very, what I would consider subpar mutual fund, sort of the post financial crisis. And so things do change over time. I'm very hesitant to give out specific recommendations. I think it's very important that you look at a chart of the mutual fund that you're investing in. I never invest in anything without looking at the chart itself. You can look at quantitative measurements and they may all signal what looks like to be a good fund. And then you look at the chart and you go, well, this probably isn't something I want to invest in. Pull up a chart of the fund, make sure it's something that's trending up. You could probably, compare it to the junk bond index to make sure they're trending in the same direction. Make sure you get that comfort level that you're investing in something that is going to provide you the risk and return characteristics that you're trying to create.
Okay. One of our listeners asked you to comment on the role of diversification in your strategy.
It's an interesting question. I think a very astute question as well. The strategy does not rely on diversification in most instances. If you were to look at the junk bond strategy, if you were to just to deploy the moving average timing techniques against junk bonds, when we're invested in junk bonds, we're very highly concentrated. And I'm okay with that. I'm very comfortable with that because I know that junk bonds tend to trend. They have that high trend persistence that we talked about, and that they tend to trend in one direction for a period of time until they don't. And when they don't, they turn over very slowly. And it's that timed drawdown that we talked about, that from the drawdown from point A to point B, that time drawdown, which has historically been in the 1% to 3% range. If they do turn down, I know we're going to sell and get out. So having a highly concentrated portfolio is not a concern when deploying this type of strategy. It's very different when you talk about diversification in what they call a strategic asset allocation or a buy and hold type portfolio, because you're buying and holding no matter what happens in the market, right? You're using bonds to be a shock absorber for your equities when market risk elevates. Now, sometimes that works and sometimes that doesn't work. Look at the year 2022, this year, for example, everything's going down. In fact, some of the longer dated bonds have gone down more than equities. And so that diversification may not always provide the protection that you're looking for. I'd much rather protect my capital and protect the downside through the active management of that portfolio and using that time drawdown as a exit signal, as a trigger to get out. I know that that trigger will always protect my capital. It may not always increase my returns. I get that. But that using that moving average timing will always protect my capital, whether you're using it on junk bonds, floating rate bonds, securitized credit, which was on that list, which is a new group that or category that's sort of been developed over the last 5 years or so, produces some very low volatility returns. But when they go down, they can go down significantly. Using that timed drawdown as a point to exit will always protect my capital. So I hope that answered the question.
Thank you very much, Rob. You've been so generous with your time and helping answer the questions. I've passed along the questions as best I can based on how I understood them and ones that would be of general interest to our audience. If anybody has unanswered questions they would like to present to Rob, you have an opportunity to either send him an email at the address he posted in the slide you see right now, or you can ask them through the New York chapter community, where there'll be a discussion, a space for discussion of this presentation. And you'll also have other opportunities to communicate and stay in touch with Rob. So we hope that we'll use community to forge lasting and deeper relationships with our speakers than we could have done under the old system, where it was kind of like one and done, where we just, clinked glasses and said good night. So hopefully community will give us more of an opportunity to stay connected. And I want to close this presentation by thanking Rob one more time for his generosity, for his insights and acumen, and also for all the service he gives to AAII through the San Diego chapter and through his other involvements. Thank you very much. Rob, would you like to say anything else before we say goodnight? A final word?
Just thank you, Hollis, for this opportunity. Always love talking to AAII groups, and please reach out to me either through the email, or I will try to make sure I get onto the New York City chapter community and try to leverage that tool set to engage in conversations with all of you, and look forward to continuing the conversation.
Thank you. My only question left is, when can we have you back?
I can come back anytime you like, Hollis. You know how to get a hold of me.
You are one of our chapter champions, and we do plan on inviting you back for an encore presentation in the future. With this, I'd like to close the presentation, say goodnight to everyone, and look forward to connecting with you on the AAII New York City chapter community. Good night.
Good night, everybody.